Okay, so with that, we are moving into our next presentation. Sorry, we're a little bit behind. It's the 12:30 commercial real estate outlook for 2020. Matt Kramer, he's a partner at Weinberg Wheeler. Matt, how are you today?
Good, Mike. Thank you. How are you?
I am doing very, very well. I'm going to turn this over to you so that you can handle your panel. And thank you all for joining.
Okay, excellent. Well, good afternoon, everyone. My name is Matt Kramer. I'm a partner with the law firm Weinberg Wheeler, Hudgens Gunn and Dial in Miami. I'm a real estate transactional attorney. My real estate practice focuses on both the Florida and Nevada markets and all real estate asset classes. My clients include buyers, sellers, lenders, and distressed note purchasers. I also handle foreclosure work and commercial bankruptcies on behalf of these parties relating to distressed real estate transactions. Deal size ranges from a few $1,000,000 to over 50 million. My transactional work has included mezz, private equity, EB5, and opportunity zone transactions. Now, I'd like to introduce you all to the panel and ask each panelist to spend a minute or so introducing themselves, and then we'll move into the substance of the panel discussion. Tony Barkin, why don't we start with you from Allagash Partners?
Thanks, Matt, and thank everybody for listening and attending, and we'll try and make it an interesting panel. Allagash Partners, I'm the founder and CEO of Allagash Partners. My partners and I focus explicitly and exclusively on working class rental housing. We currently are managing an opportunity zone fund that's investing in multiple properties, existing properties that we're buying and then substantially improving throughout the mid-Atlantic states. Again, in a qualified opportunity fund format, and then in a more standard private equity real estate fund format, we're offering a similar strategy that also incorporates, along with substantial value add strategy, an adaptive reuse strategy, and also expands the footprint more nationwide. So that's basically we are. Again, we focus on working class multifamily housing in secondary markets across the U.S.
Thank you, Tony. Next, I'd like to introduce everyone to Nick Rojo, the co-founder and president of Affiliated Development. Nick, if you could spend a minute or so on your background, please.
Sure, absolutely. Thanks, Matt. My name is Nick Rojo. I'm the president of Affiliated Development. We are a South Florida-based development company. We're pretty niche. We focus on mixed-use multifamily, and every project that we developed is a public-private partnership where we come in and raise either tax incentives or grants locally at the local level in order to solve for either a workforce housing issue or for economic development. We've recently launched our own impact investment fund. We've partnered with some local police and fire pension plans and some local plans and some family offices, and we just had our first closing last week. And we've also done some opportunity zone projects. We've recently developed, built, and stabilized an asset in downtown Fort Lauderdale in an opportunity zone.
Thank you, Nick. Lane Lowry, a fund manager with Aqua QOZ Portland. Lane, if you could spend a minute or so on your background, please.
Sure, thanks. We're in Portland, Oregon, and the environment here is fantastic for opportunity zones. We've been rated #1 for opportunity zones for the potential growth of the area. I've been focused on multifamily development, and we're using the special sauce of the opportunity zone to deliver incredible returns, primarily through the delivery of depreciation up front. When people buy into a project, they can take the depreciation and use it against other income. So we've been working in the Portland and throughout the Pacific Northwest, and we have excitement for the many different asset classes in the area, but mostly the multifamily because of the lower interest rates. So ready to get started, and we're excited for this panel.
So Lane, why don't I start with you? There's been a lot of talk about opportunity zones. We've now had some runway since the legislation has passed and developments have started. What have you seen over the last several months? And what do you envision over the next year or so regarding opportunity zones?
So the opportunity zones have had a rough start because it took so long to clarify what the rules were. Literally took years for people to become fully aware of what the rules were. In the same time, we entered into a pandemic, and the primary asset types that people were working on for development were large assets, convention centers, large hotels, and some of those asset classes are in a very challenging situation right now. So in the multifamily space, some industrial, some other prime food groups, if you will, opportunity zones are going to have an incredible upside, but it's going to be slow going for some of the other asset types. What I do expect is that there will be a lot of investment in opportunity zones in select assets. Some of the larger funds, they may have to balance their portfolios, but in a select individual asset, they can be very, very attractive, especially when the depreciation is passed through to all of the owners. The sponsors have to very carefully put together their management structure to make sure that they can pass through all the benefits. In the years ahead, it'll be very powerful.
Nick, same question to you. What have you seen since the inception of opportunity zones, and what do you see going forward in the next 12 months?
Sure. At first, you saw kind of a mad dash to figure out what was going on and figure out the program. I think a lot of people were, like Lane said, waiting for more regulatory clarity from Treasury, which has subsequently come out. We kind of with our project, we just when the rules came out, we got right to work, and we had already had our site under contract. So, I think the best QZ deals are the deals that were under contract before tax reform came out, because I've seen, land sellers in more attractive opportunity zones, realize that there's quite a bit of demand for those assets, and have, subsequently substantially raise the prices of their land for development purposes. So I think, a lot of people are looking at these deals, and you can't let the tail wag the dog, like we say, and it has to be a fundamentally sound project. And there's a lot of investors that don't necessarily have a lot of real estate experience, and they want to take advantage of the tax advantages of the qualified opportunity zones. So, you've kind of seen a lot of maybe deals that normally wouldn't have gotten done, but are getting done because there's that tax play in the opportunity zone. So I think the legislation is having its intended consequences, where there's areas of town that are now being developed that probably wouldn't have been if not for the legislation. So overall, I think it's going well.
Great. And Tony, same question to you. What have you seen, and what do you predict you will see over the next 12 months?
Sure. Actually, I think that Nick and Lane are being polite when discussing some of the projects that have come out, and Nick just described them as kind of getting done. I'm not sure that so many of them are getting done. I think that basically, to further on kind of his description, I think that there were people who owned some very cheap property in some less than ideal places that launched qualified opportunity funds when after the legislation came out, and basically to some extent flooded the market with a lot of really I think politely we could say mediocre ideas, and impolitely we'd say pretty terrible investment ideas. And I think that the OZ program as a whole suffered dramatically because on top of launching literally hundreds of deals that really didn't pencil into the marketplace, it also launched into the marketplace a host of non-professional real estate people who happen to own land who were selling an idea that you needed to invest into opportunity zones in the first year. And because that's when the opportunity was mathematically correct. And they weren't lying, because the opportunity was mathematically better in the first year, but to the tune of about 15 basis points of IRR. It really, but what they managed to convince a large swath of the market by being, extremely loud and mass, is that you should invest right away. And if you didn't, the opportunity zone program may not be worth as much. So the message that investors got was, there's a lot of bad stuff being offered, and if I don't invest now, it isn't really worth it. So why would I spend my time learning about it? And I think we wound up with a situation where a really good program wound up, because of the way the government launched it, and I guess that shouldn't be a huge surprise, but because of the way the government launched it, we wound up with a situation where it really got lost in the fog. And so I think that's kind of where we come now today, to a lot of those things kind of passing by. I don't think they got done. I don't think they're getting done. And I think that when we look forward to this program, we see a program that really does offer investors the opportunity to create after-tax wealth at a dramatically increased pace. And that there now are some very good managers in the program who understand the program, who are bringing different types and much better investments, whether they be multi-property funds, the way we're doing it, or single property investments, the way that Nick and Lane seem to be doing it. I think that now you've got an opportunity to invest and to dramatically increase wealth. And when you do that mathematically, when investors look at the potential to basically, over the course of 10 years, in a good investment, create twice as much after-tax wealth as a result of this program as they would making the very same investment in a way that didn't utilize the tax benefits of the program, I think that's going to become a very compelling sector over the long term.
Great. Well, thank you for those comments. Lane, you're bullish on the Portland opportunity zone market. Can you explain your market in detail and how Portland is differentiated from other markets in the country?
Sure. Portland is what we call the least expensive West Coast city, and it has been an in-migration location for a lot of people leaving California and Seattle and other high rent locations. And it has an incredible quality of life and a much more affordable place to enjoy work from home or the local environment. We have a lot of activities in the market. You can go from the ocean to the tops of the mountains in an hour or so. It is an incredible all year playground. Yeah, we get a little bit of rain in the winter, but we don't get the real hot and dry weather that can to just go on and on. So it is a really great location. Our market has had a lot of development recently, but we've seen this development pipeline cooling. So we expect rent growth in the years ahead. The opportunity zone in the downtown Portland area has been rated in the top 10 of the opportunity zones out of the 8,700 opportunity zones, more than 8,700 opportunity zones, because of the projected growth over the years. And recent news doesn't really indicate what's going on in a long-term trend. There's a long-term migratory trend moving into the area, and that is the story for continued development in the area. Now, we've had some changes in our laws. Both the local and state legislatures have passed laws restricting rent growth, but the laws are much better. Let's say they're least worst of all of the laws for larger cities, a 7% rent growth plus CPI. So, a typical 9% or so growth, and they don't apply in some cases to the newer properties. So if you build a brand new building, you get a 15-year moratorium on applications, some of the rules. So you have a chance to really take advantage of the lease up and the potential growth over time. Our market is supported by a lot of different kinds of businesses, and we don't have a specific single industry which, if it was to have a problem, would blow out the city. You know, so it has a pretty stable business background. So please come to Portland and enjoy some of this incredible environment.
Thank you for those comments, Lane. Nick, what should investors and developers be focused on when evaluating an opportunity zone investment?
Sure. Look, it has to be a fundamentally good real estate deal. It has to underwrite. The deal needs a pencil, and they have to realize that when the team they're working with, they're going to be business with those guys for at least 10 years. So they have to feel very confident that the development team and the asset managers and the management company, are people that they want to be in business with for a long time. I said this before, you can't let the tail wag the dog. For a couple hundred basis points on your IRR, you can't choose to choose a qualified opportunity zone deal over a traditional real estate deal just to save money on taxes, because like I said, it needs to be fundamentally sound, a project that you would have done otherwise. We're personally, we're not totally focused on QOZ. We've done one. And the reason we did it was because the project was in the QOZ, before tax reform, and we just happened to be there. So we're completely agnostic. So I may be a little jaded in that respect because we don't particularly target qualified opportunity zones. If a deal is in a qualified opportunity zone, it's great. We know there's a lot of capital out there, and if it's a good deal, it'll get done. So we don't, just to caveat that, we don't specifically target qualified opportunity zone deals, although we have done one.
Great, thank you. Tony, how has multifamily been performing during the pandemic?
I think it's generally a tale of two economies, effectively, which is to some extent flipped its head on the story that we've seen over the last 20 years. Over the last 20 years, we all know the story of two economies. You've got the high-end economy with high incomes and luxury and wealth that is done, really well. And then you've got, kind of the middle class, which has effectively now become the working class, as it's not so much in the middle, it's certainly with respect to the distribution of income, and the lower class and the classes that are making less money have done less well. Interestingly, during this period with respect to and that's been the same for assets and sectors that support those areas. So luxury housing has done much better, is in top metropolitan statistical areas across the country. In the largest areas, that's been the asset that is appreciated the most. And then as you go kind of down the socioeconomic scale, they've appreciated less. During the pandemic, we've seen actual performance be the reverse of that, which is that in the most expensive areas for the most expensive assets, we've generally seen an appreciation by the tenant for their optionality, whether that optionality be moving out into single family housing in the suburbs to get out of the cities, or whether it be renegotiating leases with landlords, or simply not paying. In the extreme in New York City, at one point, we saw around 40% of non-payment and vacancy in those areas. By the flip side, when we go to working class housing, we really haven't seen that at all. First of all, they don't, the tenants in those properties don't have the optionality. Occupancy has been extremely stable and has in fact ticked up a little bit as we've seen move-outs go down and move-ins go up as a percentage of previous year's activity. So what we've got is occupancy starting to tick up. And we've seen that payment rates, despite the fact that, I think the assumption has been with the unemployment rate that there would be a significant loss of income, we haven't seen payment rates change dramatically for working class housing. And so what we've got is a very stable asset, which really shouldn't be a huge surprise, because that, working class housing coming out of the Great Recession was one of the most stable performers as well. So it's got a good track record of performing well during difficult periods, and it's performed well here, which is not to say that you can then take that and broadly brush it across multifamily altogether, because it is very location oriented and very property oriented within that.
Great. Well, thank you. Next, Lane, curious whether you've seen an uptick in opportunity zone interests, whether in Portland or in other parts of the country.
I think generally the interest in opportunity zones has waned because of the hyper focus on what's happening with the pandemic. So the multifamily space has been one of the better assets. So a multifamily project in the opportunity zone does get some attention. One of the main things that we're asking people to focus on is, when is the asset delivering? When is it leasing up? Are we leasing up after the pandemic, or are we leasing up in the pandemic? Another one is, when do the opportunity zone benefits hit your balance sheet? One of the benefits that's rarely covered in detail is when depreciation is delivered to the partners, and how do they take that depreciation, whether or not they have basis. So what we've been focusing on with the single asset fund is how to deliver the basis through non-recourse debt, and how that turns into a depreciation deduction that survives the sale of the asset without recapture by holding for more than 10 years. So I think that there's a select group of very knowledgeable investors that are buying and developing projects for their portfolios that you don't really see very much in the news or offered online. And then there's generally the funds that don't have the ability to optimize all of those key benefits for the opportunity zone. So what they do is they find fantastic projects, and hopefully they get done with very, very good upside. But the opportunity zone was designed to take a project that doesn't have metrics that are as attractive as First and Main. You could take an area that just generally has lower growth prospects over the decades ahead, but deliver a tax benefit that results in an overall benefit to the investors that exceeds the First and Main investment. So what we're looking at is deals that may not pencil as well as First and Main, but by the time you add the benefit of the capital gains tax vacation, in other words, there's no tax for 6 or 7 years for their original investment, the deduction, the reduction of 10% on that tax that's paid in 2027, and then converting all of those capital gains of the asset to non-taxable at the time of sale after 10 years, after 27 years. And then the biggest one is the release of, the forgiveness of any depreciation, so there's no recapture. Now, excuse me if I take a little more time, but if you look at a multifamily asset that is a 27.5-year asset and depreciate the entire value of the land over 27 years, then after holding for 27 years, there's no recapture. So the benefit of that depreciation is a gift that's been given as a result of the opportunity zone investment. We supercharge it by using depreciation costs segregated and delivered as bonus depreciation in the first or second year. So I think the interest in the zones and the investments of the zones will increase when they understand these nuances and whether or not the asset delivers those. And that's how people can receive tax savings over, in excess of the original investment in their first year if they get the benefit of bonus depreciation. So I think you'll see a lot more interest over the years ahead as we get out of this news cycle for the pandemic.
I'd like to just comment because I think that while I agree with a lot of what Lane is saying, I think that the initial premise of the idea that the program is designed specifically or somehow to help projects that don't pencil as well comparatively is missing kind of one of the chief benefits of this program in general, which is that we know that so many assets in real estate and commercial real estate, and certainly in multifamily real estate especially, have become extremely expensive. And we know that it's difficult to find investment value in any sector, quite honestly, across equities and debt and hard assets. It's not an easy task. But I think that one of the major benefits of this whole program is that it gets investors to focus on areas where the prices haven't appreciated the same way. So I agree that if you're chasing land in one of the top 10 or 20 opportunity zones by metric across the country, that's going to become difficult because it's going to be a limited quantity, and people are going to understand that they can raise the prices significantly because they're in opportunity zones and because the capital will be chasing them. But if you're looking generally at operating assets that are in opportunity zones and really even in good working class neighborhoods and secondary markets, these are assets that haven't seen the pricing cycle that other assets have. You can still buy assets at 6, 7, 8% cap rates and even higher in these types of markets. And so while I know that location is the basic mantra of real estate, and it's worth pointing out that it was propagated primarily by a billionaire who happened to own billions of real estate on Park Avenue in New York City. So that may have been a somewhat self-serving propagation of what's become now a biblical mantra. But I think that really, to some extent, investment needs to be about price. And I think that the opportunity zone enables investors, and in fact incents investors, to focus on having a vested interest in areas that they otherwise don't or might or wouldn't. And it allows them the opportunity to focus on areas that actually offers, to some extent, much better economics than many of the other types of projects that they would otherwise see, because of the pricing capacity. And so I would actually argue that, especially because the program effectively is a leverage tool, which you're basically doing, I think Lane described it very well from a technical standpoint, but what you're basically doing is borrowing money from the government at zero for a period of time, enabling you to invest more. If you're in a good investment, that will return enough capital so that it pays for the tax liability subsequently internally from payments. And then at the end of the program, you're getting all of your returns on a tax-free basis. So you got basically free leverage and tax-free returns. And that's an incentive to focus on areas that most investors don't have a vested interest in at the moment. And I think that actually can provide for investment returns independent of the benefits of the tax program, for actual just outright returns that are actually, favorable and above what you can get from other types of returns.
Thank you, Tony. And your reference to a frothy real estate market is certainly something I've seen as an attorney working on transactions. And let me ask you this question, Tony. With the deployment now of the Pfizer vaccine, soon hopefully we'll have the Moderna vaccine. Is there any tie between now what we see as a light at the end of the tunnel? We've got the vaccine, and a further compression of cap rates and an increase in cost of various real estate asset classes. As a real estate attorney, I would have thought during the pandemic that prices would have come down the longer the pandemic occurred. I have not seen that. I have not seen too many distressed deals. And I'm wondering now, with the deployment of a vaccine, is a distressed multifamily real estate market something that just is not going to occur?
I think that it depends on the sector. I mean, we're all primarily multifamily here. And I would argue that multifamily is setting up extremely well for the next 10 years or longer. I mean, I think it's setting up well for the next, let me rephrase that. It's setting up well for the next 2 years, 4 years, 6 years, 10 years. But I think it's setting up really well for the extended term, because I think that what you've got is you've got an environment where you're going to have eventually some inflation, because I think the Fed is unlikely to be able to wean the economy off the drug of low interest rates quickly enough. And you've got in multifamily an asset that is with the exception of hospitality, which has other issues, a resetting asset with respect to inflation. And so I think that you've got a real asset that isn't just a doorstop or doesn't have a cost of storage, but actually has an NOI that it throws off. And I think that certainly in an inflationary environment. So I think that as we come back to normality, there's going to be, I think, a very positive macroeconomic multifamily environment. And I think that unfortunately for many of the other asset classes, the pandemic, which I think has been appropriately described as an accelerant for economic trends, is going to have a negative impact in other areas. I think it's, we're seeing it certainly in retail. I think you're going to see it to some extent. Hospitality will be interesting to see how it affects over the long term, but office spaces as well. I think those areas are just less certain. And so I think that you've got, I think there's real risk that those economic trends, even with the pandemic going away, what we've done basically is light the match to accelerate those trends. And I think that's likely to continue. So I don't know that that a vaccine is a cure-all for some of the issues that some of commercial real estate is facing.
Nick, your thoughts? Do you see a connection between the deployment of a vaccine and further compression of cap rates?
Unknown caller.
No, I mean, I think Tony said it well. I mean, this market we're in with very low interest rates and with an incredible amount of capital chasing projects. And like you said, Matt, especially here in Florida, we didn't miss a beat with the market. And in fact, I think it's gotten even hotter because of the influx of people coming to this market, coming to this area. And I want to be we're multifamily. I want to be a multifamily owner long term, especially in this market. With inflation coming on the horizon, I don't see cap rates accelerating anytime soon.
And Lane, is the pandemic a significant headwind to your business, your fund, or is the strength of the real estate market really agnostic to the pandemic right now?
The pandemic is a challenge for many people due to collections. There's a lot of people that don't pay rent, and then those turn into losses. But as soon as that is behind us, the reduction in the supply that is caused by people just slowing down is not going to be good for renters. It's going to cause a lot of rent growth. There's going to be an increase in demand. You'll see cap rates dropping as a result of just the spread over the risk-free rate, plus the planned or the foreseen projected growth in asset value in the rent rolls. So in the next couple of years, we could see an explosive growth in price and dropping of cap rates. We're seeing a 4.5%, 5% is a typical rate. And then we go and look at some other cities where 3 or something like that is common. I could see the rates across the board taking a 60 or 70 basis point drop as a compression change alone, and then another 25 to 50 basis points for specific growth in rent rolls is possible. Cap rates for opportunity zones have traditionally seen 60%, 60 basis points for opportunity zones over a regular deal. So let's say on the east side of the street, it's opportunity zone. On the west side, it's not. Same asset on the east side or on the west side, there's a 50 or 60 basis points different just to be in the opportunity zone. And that could increase. I would guess that other investment programs like extending the period for special depreciation, extending some of the benefits for opportunity zones could continue, and that would further push compression even lower. Though that's my crystal ball. I don't know about you guys.
Yeah, if I could provide a little context, we delivered an asset actually in July, and we were all holding our breath because we weren't sure, well, how good the lease up was going to be, and we ended up being fully leased, 97% leased within 4 months. It was incredible, and the reason being is a third of our tenants came from places where I never thought we would attract tenants from. And this asset's in Fort Lauderdale. We had tenants from California, tenants from Seattle, tenants from areas where I thought, hey, these tenants would normally go to Texas or Arizona, but no, they came to South Florida. We were, very pleasantly surprised. It's interesting to see how strong the demand was for that type of product in that market. I never expected, even in a normal market, to have a lease up, sign 35 leases a month. I never expected it. So, how the pandemic, we had to do virtual tours for a month. People couldn't even come see the building. So it was we had an influx of interest. So that's just an interesting tidbit.
I think Nick brings up something that's interesting here as well, which is that, again, going back to the effect of the pandemic, that technology, especially in multifamily, has proven to be really useful, and is really, it doesn't help you as much in hospitality and office and retail. In fact, in retail, obviously, it's actually for physical spaces, it's a negative. But what we've discovered in the properties that we've got in the properties that our property managers are managing, is that this technology has basically, with the exception of maybe a month of hiccup, while people went from doing tours in person to doing virtual tours primarily, and then exclusively. And we're still primarily doing, even today, virtual tours, and expect that this is likely how it's going to be going forward, in fact. That technology, again, will be a permanent feature, and is really beneficial. And again, the pandemic really was an accelerant of that. So, there are some positive long-term effects that are occurring in various, especially multifamily, but in various sectors.
So other than pricing, and obviously pricing is almost everything, but other than pricing, are there other challenges, headwinds facing the multifamily market? Or as you said, Tony, it's going to remain frothy for the foreseeable future?
I think that it's going to remain frothy in frothy I think it'll remain frothy in some of the frothy markets. I think that there's going to be a repricing of fundamental rents in some of the most expensive markets. So I think that cap rates may not change, but values could change. We all talk about cap rates as if it is the sole determinant of value, but it's not, right? Cap rates is just a multiplier. It's an indicator and a multiplier and a present value of the NOI, the net operating income that properties throw off. And if you've got a resetting of rents downward because there's people moving out of certain areas, especially the most expensive areas, most expensive multifamily areas, certainly, then I think that you're going to have some fundamental pricing changes, despite the fact that cap rates may not change dramatically. In the areas we look at, as I said, we haven't seen the cap rate cycle because there hasn't been capital chasing, and there still isn't capital, even with the opportunity zone, even with all discussion about competition. The reality is that if you're looking at underperforming multifamily assets in working class areas, and in, despite the fact that these are very good, very stable assets, they're granular. They have not been chased by the large money, and probably won't be chased by the large money anytime soon. And as a result, you can still find good value. And so I don't think that'll change. I think that we're still going to be able to find good value for the long term. And in fact, our goal is to turn good value at a single property basis into a really high performing multi-property portfolio that we can sell in bulk. That is our strategy for the fund, and the way we approach the world.
And Nick, what headwinds do you see? Obviously, pricing is an issue in South Florida and so many different real estate sectors. But other than pricing, what headwinds do you see, if any, in the multifamily?
Well, our focus is largely on mixed income workforce. So we've seen very stable collections. We haven't had a lot of delinquencies. We've had some good lease ups. So, if without, now that there's a vaccine is here, you're probably not going to see a lot of more shutdowns. So people will continue, being able to work or at least work remotely. I think a rising interest rate environment, no one expects interest rates to increase anytime soon, but that will obviously slow things down a little bit. But for the most part, I see, especially in the multifamily sector, things remaining pretty frothy and pretty strong for the foreseeable future.
And Lane, how about you? Are you seeing any headwinds, particularly in the Portland market?
We do, and we think nationally it's going to be a problem. One of the things that we see is the aging of the millennial population moving from apartments to homes to start families. There'll be more families started. The lower interest rates will allow them to buy. We've been doing the rent versus buy analysis, and there are a lot more people that are going to be able to buy. Maybe it's a condo, but they can certainly buy outside of the urban locations. We see a trend from urban living to suburban living as work from home continues to expand. One of the estimates I've seen is that there's about 66 or 67% home ownership within this country, and it is expected to continue pushing forward up to the 70+ rate. We'll recall that the housing bubble was created by too much home ownership with not enough down payment or credit. I don't think that's as much the problem today with Dodd-Frank as solid as it is and some better underwriting. But I also believe that the interest rates are here, lower rates for quite some time. So we may start seeing people shifting towards the variable rate loans where they can get in on very, very low teaser rates to get into homes. And one of the things I noticed just in the last few months of the Obama administration was the MIP was lowered for government loans. And then under the current administration, that was reversed. It's possible that that could change again under the Biden administration and see the cost of homeownership dropping even further. It's about a 50% reduction. So those trends for apartment ownership, they're not great. But for renters, there's a lot more that are going to be rent by necessity because of the changes in the economy. There's a lot of folks that their savings are disappearing and they need to rent for a longer period of time. So focusing on the demand that will be needed in the suburban markets will be great for developers, rental housing developers. There's the single family home rental market that's really taking off for portfolios of rental homes. So just watching the trends and being involved with them, it can be exciting, but there's going to be both upside and downside. It's the tale of two economies. That's for sure, as Tony said.
Thank you, Lane. We have we've touched base a little bit on workforce housing, but Nick, I know you're focused on that quite a bit. Can you talk about the benefits and challenges in developing workforce housing?
Sure. With workforce, the need is very market specific. So there's obviously a much greater demand for workforce housing here in the Tri-County, Palm Beach, Dade, Broward area than there is in Jacksonville, right, where the cost of living is substantially less. Here particularly, 60% of tenants in this market are cost burden, meaning they pay more of a third of their income in rent. And it's actually the epicenter. It's the worst place in the country for affordability. Obviously rents are higher in other markets, but incomes have not caught up to rent inflation here. And tenants are forced to either pay more of a portion of their income in rent than they should, or live in substandard housing and commute to work. So it's a big problem here in South Florida. It's read about in the papers all the time. And we're talking about people that even make good incomes, because here in Florida, that could be up to $100,000 a year. You could qualify, be on the 120, 140% of the area median income range and still qualify to be quote unquote workforce housing tenant. It's challenging from our perspective to develop because obviously, land price is fixed, construction costs are fixed, and you need a tremendous amount of gap funding or subsidies in order to bridge the gap and get these projects off the ground. So, there's also no state or federal program. So there's no workforce housing tax credit. There are some small buckets of money at the state you can access, but it's not meaningful. So what we do and what you have to do is sit down with, local government and figure out tax incentives and grants in order to bridge the gap and allow, the project to pencil. So it's extremely hard. Traditionally, people who wanted exposure to workforce housing would buy, B and C assets and do some value add to them to kind of be able to rent at a rent level and still make a meaningful return. It's like I said, it's very difficult to develop, and some of these projects have huge gaps. We did a project. We're doing one in downtown West Palm Beach, where it's 2/3 workforce restricted. It's new construction. And we had to cobble together $15 million of funding incentives to make that happen. So it's very difficult to scale a business where you're actually developing workforce housing because of the tremendous amount of subsidies that's necessary in order to make it work. So basically, if you're a workforce renter, in the foreseeable future, there's not a lot of inventory for you. You're going to have to live in either substandard housing or live in a tertiary market and not be able to live towards the downtown, or pay a very large portion of your income in rent.
I'd love to take that theme and nationalize it to some extent, because I think that what Nick is saying is 100% correct, which is that if you look at the numbers nationally, right now there's 6 million households that are paying more than that 30%, which is kind of the boundary level, and that's 30% of gross income. Just to make sure that, not kind of net income, but 30% of gross income. There's 6 million households, growing closer to 7 million households every day that are paying more than that. And at 50%, you're basically considered to be in housing poverty when you're paying 50% of your gross income. And there's over 1 million households around the country that are doing that. And it is very difficult anywhere, not just in the South Florida area, but it's very difficult anywhere to have a scalable development paradigm for working class housing that's profitable. I mean, you can go ahead and develop it, and in some cases, and wind up with treasury returns for the risk of property development. But to develop it profitably and compellingly, and I applaud Nick for doing it, because it is not easy to do these developments. We get involved in some occasionally idiosyncratically. But our strategy has been, one of the reasons that this has gotten the way it has is really, as he said, the factors for development are kind of fixed, which are land costs, construction costs, really the equity requirement to accomplish the transaction, and then the limitation on rents to be affordable. And the reason it's gotten worse is because while you can't develop, obviously the housing stock ages. So the average age or the average vintage of housing stock for working class families across the country is 1972. And so you've obviously some significant percentage of that are not being maintained the way they should. And as a result, they're going to be past their usable lives. And so we're seeing a continuous expansion of loss of affordable. And I'm not only talking subsidized, I'm just talking affordable to working middle class people, as well as lower income households. And basically our whole strategy for our Opportunity Zone Fund specifically, but even a major part of our general private equity real estate fund, is to find the properties that are still functioning but are underperforming, because you can buy those at we talked about price, buy those at extremely low bases and do the improvement necessary and at least stabilize for the community at reasonable prices while still providing mid-teens returns for investors. And so that's again, is it scalable? If somebody gave us $2 billion tomorrow to do this, that would be much more difficult. But we can have a significant impact by doing a reasonable number of projects with reasonably sized funds, over a continuous time, in the same way that it seems like Nick is doing with development and putting them together and putting these, more work intensive projects together. I think but I think it's worth noting that there's not going to be a glut of workforce housing, independent of how much capital comes into the marketplace, if you used every single available builder to build nothing but those properties, and there was no loss. It would take 8 years to fill. Which is just never going to happen, right? They're still going to build luxury. They're still going to build subsidized. They're still going to build other things. It would take 8 years to fill it up. We're looking at basically an intractable shortage. That each of these projects, especially when they offer good private returns, is really valuable to the communities.
Well, thank you for those comments. We've got a few minutes left. I'd like to ask each of you to spend a minute or so sharing anything else about your fund that you may not have expressed before, and also one or two comments about what you've learned about the multifamily sector or otherwise during the pandemic. Lane, let's start with you.
Sure. We have multiple funds with different asset types and investments. Some have a longer horizon, some shorter. And they're generally designed just to have a handful or just a couple of people involved in them so that we can decide on how to use the asset and hold it long term. It's really for wealth preservation and long-term accumulation of wealth with the lowest tax position possible. What I've learned during the pandemic is that there are a number of different things that could affect different asset types and markets, and that it's good to have a strategy in a lot of different locations. We have a strategy where we're developing for sale housing in bulk, and there is a fantastic environment in Portland that I became aware of once I got here, which is that we can condo and sell apartment communities after the fact. I come from California, where you had to do all of the planning up front. So with a few modifications, we can take a well-designed apartment building, turn it into a well-designed condo and sell it out individually. And we're seeing the prices for condos exceeding the prices for apartments. So there is a fantastic opportunity for us to pivot from apartment development to condo sales. And that's probably one of the big surprises that we've got from the pandemic. And of course, the low interest rates makes it much more affordable for people to buy. We're seeing the savings for someone to buy the same unit they would rent and save hundreds of dollars a month on a pre-tax and sometimes double or triple on a post-tax basis, because they're able to deduct the interest from their income. So that's a surprising one, probably great for you, Nick, in your market. And of course, you've probably looked at a bunch of condos already, but that's what we've been finding.
Thank you, Lane. Nick, anything else you'd like to share about affiliated development and one or two things that you may have learned during the course of the pandemic?
Sure. Yeah. Look, we're still in capital raising mode. We've, traditionally we've financed our deals with some family office relationships we've had down here in Florida. And what happened was we got the idea from a local pension fund to actually launch a discretionary fund specifically for workforce housing, and make it an impact investment fund where we're building the National Green Building standards, the bronze level, and we're offering first responders and nurses and local government workers some incentives and rebates on the rents. And we've since launched the fund and been very surprised at the amount of interest we've received. We've been through kind of the consultant gauntlet and been approved to work with several local pension groups and have some family offices involved. And like I said, we had our first closing last week, and we're going to continue to raise capital. We have 3 fully underwritten deals that are ready to go that are going to be in the fund, and a couple more in the pipeline. As far as what I've learned, I would say how important technology is and leveraging technology is in this business, especially now. Our tenants are typically on the younger side, and they obviously embrace the technology. And as we're programming amenity space, and we're looking at things like low voltage and just how important it is, especially during leasing and when you're marketing the property, to really fully leverage technology, which has allowed us to be successful during this pandemic. And the other thing I've learned is really how resilient the asset class is, especially during what we're going through now, especially in the locations we're in, with the flight of capital and flight of businesses coming to this area. Anyway, and I thank you for having me today as well.
Thank you. And Tony, we've got about another minute or so. Don't mean to cut you short, but anything else you'd like to share about Allagash Partners and what you've learned during the pandemic?
Sure. I'll reverse it. What I've learned during the pandemic, I think, is something I would hope to believe beforehand, but I really appreciate it more now, which is how much the working class renter in this country wants to pay their rents. That they don't have an income statement that allows them to fall behind. They don't have optionality, and they really work in every way possible to keep current. And I think that this, very difficult time has really proven to be very enlightening with respect to tenant payments, and the stability of working class rental housing properties. And so I think that's a big positive. With respect to Allagash, I would point out something that Nick talked about with his new fund just now, which is that I think that there's a lot of investors who feel pressured to pick particular property assets that in order to get invested in real estate. And I know it can be very sexy to pick particular properties, but in the same way, it can be very sexy to pick particular funds. But I think that over the long term, people have discovered that to pick particular stocks, rather, that picking stock funds has been a useful approach, especially for people who aren't, in the equity case, aren't equity experts. In the case of real estate, I think it's the same thing. We do primarily multi-property funds based upon and offer them in an institutional format for investors, based upon the idea that a lot of investors are not equity professionals, and that choosing 1 or 2 or 3 single properties to be involved in is not necessarily the best way to go about creating an investment portfolio. And so I would just encourage investors to think about multi-property solutions, which in many cases, especially sometimes in opportunity zones, can actually be advantageous structures as well.
Well, Tony, Nick, Lane, thank you all for your enlightened and thoughtful comments. Michael, thank you for hosting as always. This concludes the commercial real estate panel discussion. Thank you.
Matt, thank you very much. Thank you to all the the panelists. Guys, have a happy holiday.
Thank you, Mike.
Look forward to having you all back next year.